President Meerbai, my friends Deepak, Anil, Vishesh, my seniors, ladies and gentlemen, it's my pleasure to stand before you to share some of the views on the Finance Act of 2023. I have singularly considered to be a pleasure to share my views, before the participants of the Bombay Chartered Accountant Society. When I get these views vetted by the elites of the BCAS, see, one gets really encouraged, to continue to practice on laws which otherwise every day ensures that, that they are kind of webs, see, which are difficult to untangle. But the continuous activities and participation with the BCA's members helps us to see that, okay, that we are on the right track. Having said that, when one is given an opportunity to present views on the myriad of amendments which have been made by the Finance Act 2023, it's like an opportunity to present your views for the first time before the elites in respect of the law, which is just the green shoot laws. And therefore, the views which we would share and we will finally settle with your help, perhaps would decide the course of action which the whole country would take in respect of these laws. So therefore, one is conscious that, okay, the views which one is going to share are the views, which have to have something which are formidable and which will have the backing of the analysis before it. And I'll try to do the same. That's one. While we were trying to settle on the subject of the discussion, see, me and Deepak were trying to understand that how would we, name these if we were to cover all the provisions of the Finance Act 2023, as President said, that there are more than 160 amendments. And if you consider the amendments within the amendments, they are more than 200. And as a student of taxation, I find that each of them are interesting. So therefore, how to narrow the scope of this subject in order to see that, we try to fit it into a capsule of about 90 minutes. So we did two things. One is that we agreed to extend it to 120 minutes. And the second is we also agreed to limit the scope of discussion to significant amendments. But even after narrowing the scope of the subject, see, when one sat about to decide that which are the topics to be covered, one felt that there were too many significant amendments, and therefore there was once again a need to limit it to very significant amendments. So and that is a liberty without discussing with Deepak and Meerbai, see, and Anil, that, I have narrowed it down to amendments which I believe are very, very significant, very important, and which requires the validation by all the members together. With this limited introduction, let me start with, this is the synopsis of the subjects which we are going to deal with. So they are just about 8 out of, Meerbai said that there are many, and trust me that they are not less than 24. So out of that, we have reduced it to just about 1/3, and we'll try to see that, that we do justice. Now, it's not necessary that each of the subjects which has been sorted out, which is shortlisted, is the one which will necessarily be controversial or will be raising controversies, but are the subjects in respect of which some knowledge is required to be shared with you, and therefore that has been shortlisted. So first is the exemption, and this is the nice way to start with this talk is about dealing with Agniveer scheme. It's one of the important schemes which I believe is something which is going to do something good for the country. And therefore, though it's not controversial, but I thought that as a mark of our respect, we will begin our discussion with taking note of the taxation of Agniveer scheme. All of you are aware about Agniveer, that it was otherwise, when it was mooted, it got into a lot of controversies, and there were a lot of oppositions leading to riots and other things. But today I may tell you with satisfaction, or perhaps on behalf of the government, that Agnivir is the scheme, which has received a fantastic response. There is a lot of enrollment in Agnivir, and the scheme is like this, that that for the it would be enrolling youth of a particular age for the armed forces, and their tenure of employment would be limited to 4 years only. So what are the amendments as far as the taxation are concerned? One is that all these people who will be enrolling as Agnivirs would be paid remuneration, which remuneration would be taxable as a salary. There is no doubt about it. The second is that each of these, that is the Agnivir as also the government, would contribute 30% of the remuneration in a corpus. That contribution would be considered as a part of the income, but would be eligible for deduction under section 80 CCH. The entire 30% would be eligible for this. This contribution would be refunded at the end of 4 years, that is a corpus, along with the interest. And it is this interest plus the return of corpus, though it was allowed as a deduction, on receipt of it on maturity would not be taxable, would be exempt. And that's why it's part of the exemption under 1012C. So this is the sum and substance of the provisions. These are significant amendments. They may apply to very limited persons. And important last thing which is required to be noted here is that these Agnivirs are eligible to be a part of the new default regiment. That is, they would be covered by 115 BAC. And even though they would be covered by BAC, they would still be eligible to claim deduction under section 80 CCH, which is not usually. There are very few deductions which are possible. And because they are also in receipt of remuneration, they would be also eligible to claim deduction, which is 16(1) deduction, that is standard deduction. So this is sum and substance of it. Nothing controversial turns on it, but we made a beginning with this. The second amendment which I thought is important is in respect of the special economic zones. Special economic zones, the units which are operating, whether the seller of goods or the provider of the services who are operating from SEZ, and if they have settled their business, during the period 1/4/2005 to 31st March 2020, which has been extended due to COVID up to 30th September 2020. And I believe there is also a possibility of it further extending to the end of 2021. But that apart, the point is that anyone who has set up a business in SEZ is eligible for a very handsome tax holiday period of 15 years. 15 years, which may be continuing for so many people. So in respect of these people, these units which are enjoying the benefit of section 1010A deduction or exemption, as you would like to call them, there are 4 significant amendments which have been made. The first one is that now you are required to file your return of income without failure within the limit prescribed under 139(1). So you need to honor this, failing which, see, a delayed return also perhaps would not entitle you to claim this deduction. Secondly, that you are as an entrepreneur or as a unit operator, you are required to bring in your sale proceeds or the service proceeds within a period of 6 months from the end of the year in convertible foreign exchange. In the alternative, there is a possibility that yes, that failure to do so, you can apply to Reserve Bank of India, which is the competent authority for extending the period. In such case, the benefit which is claimed by you would perhaps be denied in the beginning. However, when you later on receive it within the extended period, then in such case, the benefit will be restored by way of an order of a rectification. The competent authority is presently Reserve Bank of India, and convertible foreign exchange is also defined as something which is defined under the FEMA. The next amendment which we are going to discuss about is an amendment in section 28(4). In order for us to appreciate this amendment, which has a very wide-reaching impact, let's understand what was the present position, what was the position before amendment, and what is the later one. I may be permitted to read the then existing position. The value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of business or profession. These are the words, see, which were there in 28(4), an innocuous, simple looking provision, running into not less than 2 lines. It provided that if you are in receipt of any perquisite or a benefit, whether that perquisite is convertible into money or not, if it arises on account of your operating the business or in the exercise of a profession, it was required to be taxed under 28(4) as your business income. What is the amendment which is sought to be made? The amendment expands the scope of this, and significantly the relevant part is whether benefit or perquisite provided is in cash or kind, or partly in cash and partly in kind. The first part, that is whether convertible into money or not, continues, and that is continuing as the A limb, first limb, and the second limb which has been added is whether provided in cash or in kind, or partly in cash or in kind. The other conditions relating to in exercise of business, in exercise of profession, or in the course of carrying on business continues. Now, what was the need for this amendment? Let's understand this is that there had been a Madras High Court decision of late, which in the case of Ramaniyaman had held that 28(4) was wide enough to cover the case of a perquisite or a benefit which was received in cash, overruling or disregarding or dissenting from several high courts decision which had in the interpretation of the then language of the provision had held that a benefit or a perquisite which was received in cash was not liable to be governed, not liable to be taxed under 28(4). This was the thing. Then came this famous Supreme Court decision somewhere in 2017 or thereabout, wherein the Supreme Court stated that in respect of a write-off of a loan, in respect of a write-back of a loan by an assessee, the provisions of section 28(4) would not apply. Provisions of section 28(4) did not apply. And it was this decision which had sought to settle a controversy which was bothering the tax corridors for almost a century. One felt that with this, the dust would settle on the controversy, and therefore now thereafter we would practice with some kind of a peace. But it is this decision which had settled the controversy, had been a cause of disturbing the slumber of the people in government, and therefore it has made an amendment which I am sure would continue to haunt the corridors of professions and the courts for yet another century. And what exactly would be the issues which would arise? In my very humble submission, I'll present them to you. Simultaneously, 194R, which was introduced a year back, has also been amended to cover the cases of 28(4), making it explicitly clear that a person providing the benefit of perquisite would be required to deduct tax at source under 194R. Simultaneously, and this is very disturbing, is that the prosecution provision also has been amended to provide that provisions of section 276B also would apply in a case where there was a violation of just not deducting tax at source. See, I can understand that, that yes, that I have not paid tax on my income and you punish me with the taxes, with interest, with penalty perhaps, and perhaps with prosecution also. But for not deducting, not acting as an agent dutifully on behalf of the government of India. It's just an onerous duty which is cast on the deductor. But be that it may be, this is also a provision which has now been introduced, so we need to take care of it. Considering the fact that that we would always be dealing with various aspects of various amendments, one would straight away jump to the issues which would arise to that permission you may give me. So first is whether this is a clarificatory or a prospective amendment. Apparently, the government and the finance minister have clarified that this amendment is effective from assessment year 24-25. And there is no reason there for any one of us to believe otherwise. Of course, see, there have always been spoil spots, see, wherein the view which is being canvassed is that this decision of Mahindra otherwise also has not settled the law on all corners of the issues which are bothering the profession. But be that it may be, I would take a view that this is not a clarificatory amendment. It's been expressly provided that it is effective from assessment year 24-25. It's not for clarification. And even if it is for clarification, the fact that it has been provided for with effect is made applicable from AY 24-25 would be sufficient for us to begin with. The important thing which we have to note about is that this benefit and perquisite, which we are going to talk about, for which the amendment has been made, is something, both the terms are not defined at all. But these terms have been referred to it at different places of the Income Tax Act. And which are these places? One is 2 subsection 24, section 17, rule 3, and now of course section 194R. So for understanding the meaning of the term benefit or perquisite, should we be guided by any of the provisions? Once again, none of these provisions have taken the pains to define what do they mean by perquisite or a benefit. And in some of the cases, it has been upon the courts, and courts have assumed the power to determine that what a perquisite or a benefit should mean. But again, those decisions have been delivered in the context. And 2 subsection 24, section 17, 194R are all contextual provisions, and they must be read in the context also. So this would, in sum and substance, in my limited opinion, would mean that, that every time you face a situation, you will have to have your own interpretation based on, of course, your experience and the decisions of the courts, but you will have to look into these facts afresh in order to determine whether a particular receipt is a benefit, a particular provision is a benefit, or a perquisite. So it is an open house, and one will have to always consider and supply a meaning. And the sooner we start supplying the meaning, it would be better for the taxpayers. Whether there is a circular which is issued under 194R very recently, previous year, is that it has taken upon itself, the CBDT has taken upon itself to tell you that what could be perquisite and what could not be the perquisite, or what could be the benefit. So should we be guided by it? The answer once again should be strictly no, no, no. CBDT is not in the business of providing interpretation, which is strictly the domain of the parliament, the legislature, and otherwise the courts. The secondly is, that it otherwise also, that circular itself is the cause of heartburn in respect of lots of areas. So therefore, to be guided by the circular would be, to my mind, is not correct and should not be done. The circular also, the CBDT in its wisdom, because it's empowered to remove certain difficulties for hardship faced by the taxpayers. So in its audacity, it has also provided certain cases wherein they have said laudably is that these particular benefits would not be considered as benefits of perquisite. Should we once again be guided by those reliefs or the rebates, which have been given in the context of section 194R? The answer would be no, we should not do so. That we will have to independently decide whether a particular benefit is a benefit covered by 28(4) or not. The next in line is the gratuitous receipt. That what two important things we need to keep in mind, and it should be guiding our course, forever, as far as interpreting 28.4 is concerned. One is that I must be in receipt of a benefit or a perquisite. Whether convertible in kind or not is not relevant. Whether received in kind, whether received in cash, partly in cash or partly in kind, maybe after amendment may not be very relevant. But what would be significantly relevant would be that such benefit or a perquisite is received in the course of business. Because 28.4 is all about business income taxation. And unless I receive something in the course of business or in exercise of my profession, that particular receipt, even if it is a perquisite or a benefit, would not qualify for being taxed under section 28.4. Make no mistakes about it, and I don't think there is any confusion or controversy about it. If there is no business, there is no perquisite taxation. Even though there is a perquisite, if business is not there, this is not. If there is no exercise of profession, there is no taxation. So this is something we will etch it in our hearts, so that whenever we address any issue relating to perquisites or benefit, this. So in this background, please appreciate whether a gratuitous received which a person has received, is it a perquisite or a benefit? A receipt could be, because now even a cash is covered. So a receipt could be a perquisite or a benefit if it is not a sales consideration or a service consideration. But the issue is that if it is in the course of business, even if it is labeled as a gratuitous, it would be covered by 28.4. But if it is simply not in the course of business, then in that case, I am afraid that 28.4 will have no teeth to bite. To give you an example is that if you are happy with the driving of a cabbie and if you tip him, then in that case, see that being happy with driving of a cabbie is a rare thing. So, but if you're happy about it and if you tip him, it will be taxable in his income as an income from profession or business, whichever you take it. But for being shut, keeping his mouth shut for 25 minutes while you were traveling, and if you're happy with his personal quality and if you tip him, then in that case, it would not be in the exercise of his profession, not in the course of his business. I'm just joking. There may be many other good qualities. What I am trying to impress upon is that if anyone is paid for any of his personal quality, in appreciation of his personal quality, even though the person is otherwise in the business or profession, then in such case, that would be a receipt would be outside the ambit of 28.4. This is something, that balancing act will always have to be kept in mind. This business, profession, and personal, this distinction will have to be carried out. Is it received in the course of business? As I said, we have already touched upon this. Is it in the exercise of profession, or it's given to me for my personal quality? If it's personal quality, then it should not be taxed. That's the view which I would like to share with you. The method of accounting and retroactive application, though the benefit, the provision is prospective. We have agreed that it is prospective. But could it have a retroactive application? And to give you an example and to cut the matter shorter, that take a case of a person who had taken a loan from someone, and it was agreed few years back that that loan is not refundable anymore. The lender had already agreed to forget about recovery of the loan. And for some reason, for whatever reasons, and there could be many reasons, as a chartered accountant, I can share with you, but that's not the subject of discussion. The person has accounted for the write back in the current year. So your method of accounting has moved in such a way that you have accounted for the write back in the AY 24-25. Then in the such a case, see, would your method of accounting determine the application of 28.4? If you say that, yes, it is method of accounting which is paramount in taxation of business income, then in that case, I am afraid that you would be hit by 28.4. But if you subscribe to the other view, which is not an impossible view, 28.4 is all about providing benefit or a perquisite. And should it therefore not be so that the year of provision is very important and not the year of accounting for the right back, which is important? Other view is not impossible, and perhaps it is tempting to take other view that in the year when it was agreed that the lender had agreed to forget about his loan, recovery of his loan, then that should be the year, and therefore 28.4 may not bite you. But other view, as I said, is also possible, because generally we have been arguing that it is my method of accounting which should decide my taxation of business income, especially in the context of the developers, builders, real estate positions, that we used to say that method of accounting is relevant. So therefore, let's see what would turn about it. Strangely, that there are now under the new provision, there are two limbs, A and B. A is what it was. That is whether convertible in money or not. That is retained. And because it is this term convertible into money or not was bothering the tax gatherers, that's why this amendment has been introduced. So now once again it says convert whether received in cash or kind. Cash is what they wanted to cover and they have covered it, which is fair. But why would you continue with cash or kind? That kind is not being kind to us. And therefore, this kind, cash or kind, partly in cash and partly in kind, is therefore the purpose. In law, we have been taught that everything which has been put into the act has to be given some meaning. Nothing is redundant. So therefore, we have now two sets of provisions which is seeking to serve the same objective. So therefore, this is something someday, the courts will have to be deciding that what is the difference between the two. Right now, honestly, I do not have any difference which I could identify with an example. The next is where receipt is in consideration of a payment made. And what I mean here is that I have made a payment. I have made a payment for receipt of a set of goods or set of services. And in continuation of purchase of goods, that some further goods are provided to me, or better is that some further services are provided to me. The case of after sale services. In such case, could you be saying that yes, that as and when I receive the after sale services, there is a benefit or a perquisite? Perhaps yes. Is it in the cost? Perhaps yes. But the point is, have I not paid for it? The point which I am trying to make, is that whatever is paid for can never be a perquisite which is taxable. When something which I have not paid for, this is a golden rule which, or at least a silver rule one should try to apply, that if something is paid for, then there is no business to treat it as a perquisite or a benefit, even though it is so. So this is something which will carry home well. This would therefore also cover the cases of composite payments. Normally what happens is that that you are buying a particular thing, but along with that you buy several other things also as a part of this. Like you buy a car, but along with that the wheels come, the stepney comes, the Tommy and Jack comes, and so many other things come. The music system may also come. Now, as long as it is considered as a composite payment, and thereafter, to say that, okay, in addition to the car, I have received few other things. I'm not giving you a very appropriate example. I'm conscious of it. What is in the back of my mind is that anything which happens as a follow-up of my purchase for which the payment has been made, that is not to be considered as a taxable perquisite for the purposes of 28.4. That is what. The next is that you might offer many things to me. But I am not enjoying it. I am not interested in it. Then in such case, could it be considered that just because you delivered something by post to my place, that I should be considered to be a person who is in receipt of, or who has been provided with a benefit or perquisite? I have not enjoyed it. So therefore, in such cases, see what should be the case. Like somebody sends me a ticket, you know, for traveling to say Himalayas. And I don't enjoy that. I don't exercise. I don't consume the thing. Then in such a case, could it be considered simply because a ticket was booked in my name? So this is also something one will have to link it to this, that, there has to be a conclusion. Simply an offer by itself, or even something which is thrown in your lap by itself, should not be considered unless it is consummated. To me, consumption is important. And so therefore it's a two-way transaction. A perquisite or a benefit is a two-way transaction. There must be an offer, there must be an acceptance. Unless that is done, unless that is established, see, one should really contest this, keep the issue open. As a follow-up of that is that when there is a tax deducted by the provider of the perquisite under 194R, because the poor fellow, if he doesn't do it, he may be jailed also. So then in such case, he has dutifully deducted it. But simply because a tax is deducted, and there is some funny mismatch in your 26AS or AIS thing, that in such case, should it be that I should be hanged as a recipient of a perquisite? Once again, I don't subscribe to such fantastic ideas, that it was his job to deduct tax at source. It did not necessarily become my income. If you want to screw me, then if you want to tax me, then in that case, prove that, that it is taxable in my hands. This is again. The next one is very important, is about receipt of damages. Every day, even right now, while we are talking, somebody is paying damages for some contravention to some other person who has been hurt because of non-performance of the transaction or excessive performance. So in such cases, the compensation which a person receives, the damages which a person receives, could it be considered as a perquisite or benefit? It is in the exercise of business, course of business. It is received in cash also. So can you say that, these damages are nothing but perquisites or benefits? Because the noble idea of the government of India is that anything and everything which cannot be labeled as a revenue, would be taxed here. So therefore, in such cases, the idea would be that, can you ever say that damages are perquisites or benefits? Let's delve little deeper into it. On just scratching the surface, you would realize that why are you paid damages? The damages are paid because somebody has violated you, violated your rights, has hurt you, has not performed something which was promised. So can something which is paid for relieving you, or at least redressing in part the hurt which is caused to you, would ever be considered as a perquisite or a benefit? Can it ever be a benefit? It's a compensation or a damages. How could it be a benefit or a perquisite? Perquisite or a benefit, by dictionary meaning or otherwise, would mean that, that you were doing something, and in the course of doing that, somebody is happy with you and has given you something more than what you would otherwise have agreed to, what you had negotiated for. This would be the perquisite or a tax or benefit, which I don't believe is the damages. So this is something which is going to be a major cause of conflict. Then the next is also important, is when I receive benefits in the capital field. When I receive benefit in the capital field, it may be still in the course of business, because in the course of business, I might have purchased something which is on capital account. And when I receive some benefits in the capital field, could it be said that, that I was provided free services of my vehicle for 3 years? That would be considered as a benefit or a perquisite. Even if it is so, was it not on the capital field? Because vehicle which I have purchased is not my revenue expenditure. And there is a scope here to hold that this is not a perquisite or a benefit. Other view is possible, but better view appears to be that any benefit which is in the context of a capital field should not be considered as a perquisite or benefit for the purposes of 28(4), which is talking about taxation of a business income. That's what. So something has to be of a revenue nature by itself. That also is another rule which we will have to keep in the back of our mind, that it cannot be everything and anything which would be covered. The last perhaps is subsidies, subventions, and the interest-free loans. There could be multiple views, not just two views on this, but Supreme Court recently in Excel Industries case had held that grant of interest-free loan could be a case of a perquisite or a benefit. And if that has been considered to be so, then there could be a case that when you receive something as a loan, interest-free loan, subvention is again a concessional loan, concessional rate of interest. So these are the areas on which some more work will have to be done, including by me, so before we close this matter. Waiver of business debt, yes, traditionally we know that, this is a 41-1 situation, something which you have claimed as a deduction in computing the income, is later on not required to be paid for. Then in that case, 41-1 should apply. So when 41-1 would apply, would it be a case of 28-4? That has been, if you see all this, most of the cases of the government is that the assessing officer has tried to plug you a case either under 41-1 or under 28-4. These are the two alternative things, see, right? So therefore, there is, while 41-1 there may not be any doubt about its application in respect of a debt which you have claimed as a deduction, but now 28-4 also it could be a stumbling block which we will have to negotiate out of. Waiver of loan unilateral capital in nature. This is something which was the reason why Mahindra was decided. Why Supreme Court decided that 28-4 is not applicable in the facts of the case of Mahindra. Right. Now, in such a case, when somebody has waived a loan, which is a unilateral write-off by the lender, not followed by a write back by the borrower, in such cases, would 28-4 apply? Could it be considered as provision of a benefit or a perquisite in the hands of the borrower? I would believe more so that there is another view possible, more so when what is written back, even if it is written back, is in the nature of a loan which was taken in the capital field. It was not in the nature of a revenue field. So when you write it back, Mahindra has not decided this aspect. Mind you, Supreme Court has not decided this aspect. Perhaps after Mahindra also there is a lot of heartburn wherein the department continues the story of following solid containers and Logitronics and other cases, wherein the idea is that if a loan to begin with was taken for working capital requirements, then in that case whether Mahindra would apply or not is a doubt which has been kept open. I would take a view that irrespective of Mahindra's decision, a loan taken for the purposes of loan which was in capital in nature, not for the purposes of by working capital or otherwise, so it would never be considered as an income in the hands, because to begin with, the source of loan, the objective of the loan was not to claim an expenditure. Objective of a loan which was to borrow the funds which were returnable by nature. So the nature, on write back, the nature of the original nature would not change. So in that view of the matter, it would be appropriate to take a view that post amendment also, when a loan which is written back, which was in capital, which was better in capital nature, then in that case, it would not be considered as an income. We'll do little quicker now. Cases of reimbursement of expenses, providing trips, foreign trips, conferences, samples, rebates, and discounts. These are all cases which are expressly covered by 194R. In the context of 194R, the CBDT has taken a very convoluted view in case of reimbursement of expenses, which is not agreeable, at least to me. And therefore, one will have to take his own stand that whether any one of them or all of them or some of them could be considered as a perquisite or benefit. Largely, it appears that most of these are in the nature of perquisites, unless you are in a position to demonstrate that it was out of the gratitude attitude of the provider that that the person has received this. Other than that, all of these are in the course of business. Only in case of rebates and discounts, a view could be taken that it was something which was a composite transaction. There is no separate transaction of providing rebates or discounts. It's part of my purchase of services, purchase of goods, and therefore should not be considered as a perquisite or a benefit independently. The cases of influencers and promotions. There are lots of influencers these days who help promoting a particular product or the services. Now, in such cases, whatever they have been provided with by the manufacturer or the service provider, surely this would be a case of a perquisite or benefit in their hands, or remuneration also in some cases. Receipt of rights and bonus shares, it is something, see, there have been, in the context of a case of a director who was the employee of a company, allotment of shares at a concessional value was considered to be a perquisite or benefit, but that was for the purposes of taxation under the head salaries. It was also considered for the purposes of section 224 in case of a person holding a substantial interest in the company and he being a director. Howsoever, whether that interpretation provided by the court would be applicable for interpreting 28(4) is debatable. To cut the issue short is, I would take a view that, wherever you have been allotted shares, right shares, or when you are allotted bonus shares, it is allotted to you as in your capacity as the investor of the shares, and it is not in the course of your business. Even for a dealer in shares, when rights are offered to him or bonus are offered to him, Supreme Court way back had held that it is an independent transaction and should not be confused with the business income taxation. And whenever those shares which were allotted, when they were sold, in such cases, what would arise in the hands of the transfer or dealer would be capital gains and not business income. So not the last word has been stated on this, but this is something we'll have to keep in mind. Redemption and buyback of bonds and shares. I'm talking about a company which is redeeming the shares or buying back the shares, and in the process it's received certain concessions. Can that be considered as a perquisite or a benefit? I would believe that, redemption or a buyback would be under an agreement and would be guided by the public perceptions, and therefore there is no element of a benefit or a perquisite in this redemption or a buyback. Then after sales services, warranties and performance guarantees, we have talked about this, that you have already paid for this. So whenever you paid consideration, there is no question of perquisites. Incentives in free buys or freebies, see, they would surely be considered as if it is received in the course of business. With this, we would travel to the next deduction. Next amendment. The first few took a long time. I'm conscious of it. So we'll try to see that we speed it up. Somewhere you might permit me to present an overview of the subject and take you straight to the issues. So let me start with this 43BEs. That 43B is a provision which is about disallowing a deduction in respect of an expenditure unless it is actually paid for. So one more addition is made to this, that which provides that if you make any payments to an MSME, micro, small, medium enterprise, we'll talk about that, medium is not included. So any payment which is made to MSME, which is not within the time, then in that case, irrespective of your method of accounting, it would be allowed in the year of payment. So actual payment is something which is necessary. The only exception which is emerging out of the explanatory memorandum is that if the liability to pay has accrued in 1 year, but the actual payment is made in the next year, and that actual payment is within the time permissible under the MSME Development Act, then in such case, in the year of accrual, which is the sole exception, that you will be able to claim exemption. You will be able to claim deduction in that year, but in all other cases, in the subsequent year when you make payment, you will claim the deduction. Other important thing which we need to note here is, which is the law, is that even where you have paid the amount after the year end, but before the filing, before the due date of filing return of income, that will not permit you to go back to the year of actual accrual for claiming the deduction. So such a provision is there in respect of other payments like sales tax, excise, VAT, GST and other things. But this provision is not available in respect of this payments to the MSME. If you have not claimed any deduction, the question of disallowance does not arise at all. So if for some reason, if you are not claiming it on accrual basis, or it is relating to the capital expenditure, then in that case, no disallowance would be possible. This is an overriding provision. It will apply only to business income taxation. The allowance will be in the year. So we will talk a little more about this. Yes. So before I take you to the issues, let's in very brief understand that this provision is applicable to a micro industry or a small industry and not to medium industry. What is a micro industry? What is a small industry is defined with reference to its investment in plant machinery and equipment and turnover, which is a cumulative condition. So when you satisfy these conditions, you would become a micro or a small enterprise. That is one. The same act also provides the time limit for payment. The time limit is assumed to be 15 days from the date of acceptance of goods. So if you have failed to pay within 15 days, then in that case, there will be a disallowance. It will be the allowance would be only on actual payment. The other thing is where there is an agreement to defer the payment beyond 15 days, that is possible. Then in that case, you may still make the payment within the agreed period. But that period in any case would be frozen on 45th day from the date of acceptance. Matlab, you cannot have an agreement which will extend the time beyond 15 days of providing services or provision of goods. When the property in goods is passing, that is considered as acceptance. So that is considered also as an appointed day under this act. So these are the things which you need to know. Further, you need to know is that you need to be a supplier of goods and services. If you are not a supplier of goods and services, MSME Act does not apply to you at all. So this provision can bite you provided you are a supplier and you have received some goods from a supplier and you have not made the payment to the supplier. If a person is not a supplier, then in that case, provisions will not apply at all. So who is the supplier? Supplier is the person who provides the goods or services. Supplier is a person who is registered, who has filed a memorandum under section 8(1) of that act, and therefore is considered to be a person who is registered under the Udyam scheme for the micro and small enterprises. When all this happens, then these provisions would apply to you. So this is something we will keep in mind that yes. Hmm. Well, if you are covered by MSME, and if you are supplier of services, which you are, and if you have registered yourself under the MSMEDA, then in that case, and you have filed the memorandum, and you are an Udyam registered person, and if I am not paying your fees by the year end, then it would be allowed to me as a deduction, but the year in which it is actually paid. But the issue is that what if an auditor is not a micro or small enterprise, or even if it is a micro or small enterprise, if it is not registered, then in such a cases, initially, see, one was of a view that, that if I am not registered, still in such a case, as long as I am a micro or small within the definition of MSMEDA, it does not, 43B does not demand that I should be registered under that act. Yes, what is important is to determine whether I am in a micro or not. But the other view is that for you to be labeled as a micro or small, you need to be registered. If you subscribe to that view, then if an auditor's firm is not registered, then in such a case, see, this would be so. The difficulty is, see, the one would tend with the second view is that you need to be registered for the reason that it is practically impossible for a supplier, buyer of a good, to find out whether each of his supplier is registered or not. So in that view of the matter, it would be more practical to take a view that unless you are registered, there is another probability difficulty also, that how would the supplier come to know? How would the buyer come to know that supplier is registered? Now, this is knowledge based disallowance. That's what is sought to be made out. I would not tend to agree. I would believe that, yes, in fact, under MSMEDA, there is a suggestion by issue of a circular that each one who is registered, should at the time of buying goods, supplying goods, he should inform the person that he is registered under. This is by way of an information. It is not compulsory, but this is the way it would go about. So these are in sum and substance the provisions of MSMEDA, which I have tried at least summarily present before you. Now, what are the issues which would arise in the context of business income? Take a case of a person who is not a supplier, who is either it is registered or not registered, but who is not a supplier within the meaning of supplier under section 2 subsection A of MSMEDA. Then I would believe that, the payment would not be hit by 43B. Then there would be cases wherein, the person is a supplier of goods or services, but what I have received from him is not goods which I have not which I have not acquired in the capacity as a buyer of the goods, because the transaction under MSMEA would be completed provided the transaction is between the supplier and the buyer. So if there is buyer who is not in existence, then in that case, see, or I have done something not in my capacity as a buyer, then in that case, and the example which I am placing before you is a case of interest on loan. Is a case of an interest on loan. When I have borrowed funds, I am required to pay interest, which I am claiming as a deduction. I would believe that 43B in such a case would not apply. Yes, there is a provision already for disallowance of interest, but it is the interest on late payment of dues in respect of the goods acquired. So there is a distinction between the two. You may keep it in mind. Then whether it would apply, 43B would apply to capital expenditure. Again, the answer is no. Then the cases of supply made before 1/4/2023. The cases of supplies made before 1/4/23, for which the deduction, if claimed before 31st March 2023, should there be no issue at all, because 43B is not in existence in its present format there. However, if you wish to claim this in AY 24-25, then actual payment test will be applied. You will not be in a position to claim it simply by following a method of accounting which permits you to debit that expenditure, even though the supplies were prior to 31st, up to 31st March. Then cases of no agreement, where there are no agreements then in that case, the actual year of payment alone will decide whether it is so or not. There is no default presumption that where there is no agreement, it would be 15 days. There is no default presumption. Where there is an agreement, it could be for 15 days, it could be 45 days, it could be beyond that. But in such a case, 15 days would apply or 45 days would apply. Then supply by one micro or small enterprise to another. Would they be covered also by 43B? The answer to that is yes, it should be. Because it's not restricted that, if the buyer is not an MSME, then in that case, it would not apply. It would apply either way. Registered or not registered, something we have already discussed. Presumptive taxation is simple, but it is something which is bothering many, and therefore I have taken it up, and there are some small issues which are revolving around this. Permit me to assume that all of you have been made aware of what the amendment is, that the limit is raised from 2 crores to 3 crores only in cases where the cash receipts are up to 5% or less than 5% of that. And in such a case, it will go up to 3 crores of rupees. Similarly, in case of a professional, from 50 lakhs, it will go up to 75 lakhs rupees. So up to this, presumptive provisions will apply to you. This is what is the sum and substance of this. The other important thing which we have to keep in mind is that even where the payment is made, received by a check, if the check was not an account pay check, then in such a case, it would be considered as a transaction in cash. So your receipt would be considered to be a deemed cash transaction. So this is the amendment. Now, what are the issues which arise that we would concentrate? Your quantum of income is continuing to be same. That is 6% or 8% would not change. It continues even after the amendment. Important thing which we need to test here is what is cash. What exactly is meant by cash? That up to 5% I am permitted to take cash. Thereafter, anything over and above is not a cash. So what is cash? Cash is something which is not defined. In the context of our country, it would be believed that cash is our currency, which is a currency authorized in which, which is authorized by the government, in which the transactions can take place. And therefore, non-account pay checks also are considered to be cash. So anything which is not a currency and may be considered to be a cash, may be considered. So payment in foreign currency, unless it is considered to be in kind, it could still be considered as some payment in cash. But other view is possible on this. Now, non-cash transactions would be not covered by cash. Credit card transactions would not be covered by cash. Barter transactions would not be covered by journal entry transactions would not be covered by cash. So these are something which, in my opinion, would be outside the ambit of calculation of 5% of tax. Carrying this further, if a cash is received by a third party, if a cash is received by third party, not foreign on my behalf, but it's paid to third party, and thereafter he has adjusted it against the dues which were payable by me to him, then in that case, the issue would arise whether this is a cash. I would believe that cash is to be examined, whether it is cash or not, is to be examined qua myself, qua the businessman's. So when you consider my turnover, you consider the cash which is actually received by me. So if a cash is received by a third party, then in that case, this is something which should be excluded from this. Then if the cash is received in the next year, once again, what is to be done is that apple is to be matched and compared with apples only. So when I have to examine whether the limit of 5% applies in my case or not, what I need to examine is something which is included in my turnover, in respect of which the cash is received in the next year. During the year, have I received any cash or not? If the answer is no, then my view would be that even if you have received cash in the next year, for the purposes of this year, for applying the limit of section 44 AD, that should be not included in the limit. Then when I receive something which is dues of my earlier year sales, that would also, I would believe, on the same analogy, should not be included in the cash because it is not pertaining to the same turnover. What's important is, what is my turnover? Is the turnover to XYZ, from whom I have received cash, is received from PBC. So in such cases, that is something which is not included in the turnover should be excluded, even though if it is received in cash. Capital receipts in cash has nothing to do with turnover. I don't think that you will have any disagreement on this. Non-business receipts in cash again would be excluded. I never thought that, the term cash could be the subject matter of so much of interpretation and discussion. But when we are about to present some case relating to a provision, I felt it appropriate to discuss this. Turnover and this gross receipts and cash, same method should be applying. That's something which I have been consistently saying. In fact, there is a guidance note of ICAI which has said that certain business receipts like dividend, interest, royalty, rent would not be considered as receipts for the purposes of turnover. And if that be so, then this could be kind of a light for us to follow guidance notified. What's interesting to me is that whether this is automatic or optional. See, I would believe that 44 AD up to a particular limit could be automatic. And therefore, anyone who does not want to be covered by 44 AD or ADA should get his accounts audited, which is simple. But, my turnover is more than 2 crores. It is less than 3 crores. And I have surely not received the cash, which is up to 5%, which is more than 5%. Then in that case, can this be imposed upon me, 44 AD? Can I simply not say that, yes, that you are right that, my turnover is 3 crore. But I believe that this is handed over. This amendment is made as a concession to the assessees to continue to fall under 44 AD. So this is something which is open for debate, but I would believe that it cannot be imposed on me. Cannot be imposed. The last thing is that when I have received cash, which is up to say 4%, then in that case, the quantum of income which will be presumed would be not 6%, but would be 8%, though I qualify for being treated as a business which is covered by 44 AD, even after the exceeding the turnover of 2 crores of rupees. But it is this amount of cash which I have received, that income pertaining to that would be presumed to be 8% and not 6%. This is just, I was struggling with this, and there is everywhere, when you talk about 44 AD, there are surely questions on 44 AB. Though there is one single amendment which says that 44 AB is not applicable, which is otherwise also was understood. That 44 AD, whenever 44 AD or ADA applies, 44 AB would not apply. There were provisions under AD and ADA, but not under 44 AB. This year, the amendment has been made, which is a consequential amendment. But there are scores of questions which come about when 44 AB would be applicable. So I have dutifully listed all those cases. You may please go through that. In case of a business assessee, when would you be liable to tax audit, or when would you not be liable? Similarly, for professional assessee also, it would be so. So I may be pardoned in not dealing with each of them. Then comes the capital gains. This again, we will take an overview only. Overviews wherever possible, right? But issues we will consider, so don't worry about them. And sometimes issues are many, and they are not my making, finance minister's making. Yes, this is a story about, a new instrument which is introduced in the market by the government, is that when you monetize your gold, and when in exchange of the gold which you hand over to a vault manager, you are given an electronic gold receipt, EGR. You are given an electronic gold receipt, and you can, at the end of the maturity period of electronic gold receipt or any earlier period, you can go back to the Reserve Bank of India or whosoever is the issuer, and they will hand over the gold back to you. So there is a transaction of handing over gold to the government and receiving it back. So there is a conversion into gold, into EGR, and from EGR it is reconverted into gold. And when you hold this gold in EGR, you are given some interest also by the government. The issue today is limited about taxation of this. And what's provided is that when gold is converted into EGR, there obviously is a transfer, because it's a case of a barter that gold is exchanged for another financial instrument. So there is a case of a barter, and if whether in such case whether there is a liability to tax or not. So 47 is amended to provide that such a transfer is a case of no transfer and therefore no tax. Then when EGR is reconverted into gold, whether there is a transfer or not, again it is clarified that it is a 47 transaction and it's a case of no transfer. This is the sum and substance of the amendment. But as it so happens that every amendment brings with it lots of issues. So whether in such kinds of cases, because 54 EC is not amended, 242A is not amended, 49 is amended. So therefore, what is provided is here is that is what happens when subsequently the gold which you have received on reconversion, when it is again sold, what would be the period of holding? What would be the cost of acquisition? What would be the indexation which would be permitted? I'm sorry. The points which we need to know about is that these EGRs will be dematerialized. They will be permitted to be traded on stock exchange. The gold independently can be sold in the open market also. Permission, the exemption under 4770 is to all persons, irrespective of his residential status. The exemption is limited to conversion of gold to EGR to gold and not anything else, which is something we will keep in mind. Conversion of gold into stock in trade or gold held as a stock in trade converted into the capital asset is covered by 45(2) and 28(6)(a). These are the transactions which are not exempted under 4770. So we would keep that in mind. The sale of EGR or gold is not covered by the amendment. If you sell EGR after having acquired EGR in the open market, because it's a tradable security, then in that case, the gains which you would make would be taxed either as a business income or a capital gains. And if it is capital gains, either as short-term capital gains or long-term capital gains. And when you do so, then all these issues surrounding the period of holding and also the cost of acquisition and its indexation will arise. Then there could be a situation of tagging the period, that wherein I had acquired the gold, I was holding the gold, I have exchanged it for EGR, and thereafter, instead of reconverting it to gold, I am selling that EGR. So at that point of a time, what would be my period of holding? EGR is a separate financial instrument and its period of holding will be independently determined under section 242A in the host of explanations which it is there. So this is not one of the transactions. So in such cases, unless that EGR becomes long-term, which because of it being a financial instrument, the period of holding prescribed is 12 months. While in case of gold, it will have to be 36 months. So if after holding it for 12 months, if you sell EGR, it is long-term. Okay, but it would not be exempt like 4770. And when you receive gold back, Your original period would not be tagged to this. When you receive gold back, what is important is golden rule according to me is that if you ever were to sell gold, if you ever were to sell gold, make sure that what you are selling is a long-term capital asset. You go through the exercise of applying 242A and then see whether any of the explanation extends the period of holding. If it is not, I am afraid that if you are not holding for more than 36 months, it might be a case of a short-term capital asset, and the gains would be, attending gains would be the short-term capital gain. Then this is because it is dematerialized, the provisions of 45(2)A would also apply. So that is, the FIFO would apply for the purposes of determining the taxation. So please keep it in mind. If you are a trader, obviously it would be business income 47(7)D would not be applicable to your case. These are the things I have already discussed. This is something I had for almost a month. I had not been able to understand what is the significance of this amendment. 45(5)A is a gift of Arun Jaitley, the then finance minister. In 2017, he gifted to persons to defer the taxation. In case of a land or building owner, a person would transfer the property but had no money to pay taxes. Then in that case, see, there is a case of a deferment taxation. It's not something we are going to discuss today. For that's 45(5)A. Simultaneously, 194 IC was introduced for the purposes of deduction of tax at source. These are the provisions which are there. What happened was that in 45(5)A, it was provided that any consideration received in the form of the area sharing and the cash would be considered to be the consideration and would be brought to tax in the year of completion of the project or receipt of occupation certificate. This is. But when it came to 194 IC, the scope was little larger when consideration was in cash or check or bank draft. So therefore, there was a view prevailing, it seems, because this is what is the reason given in the explanatory memorandum, that many had taken a view that when consideration was received in check or by draft or any other digital mode, that consideration was not taxable at all, was to be excluded. And perhaps the government, instead of defending its own case, that made out a case, felt that, this perhaps was a lacuna, and therefore the amendment is now made. And the reason for introducing the amendment is to bring it in line with the language of section 194 IC, and amendment is made. All right, you could have clarified it, you could have made it retrospective also. But now you are saying that you are making it prospective, making it applicable for 24-25, and therefore you are admitting that up to 24-25, anything which was received by check, was not taxable at all. So what would be the case in respect of assessment year 18-19, 2018-19 to AY 2023-24? I would be foolish in concurring with any such idea, but the interpretation certainly supports this idea that when you say that it is prospectively applicable, and when you say there was a slip and that slip is being now covered, then in that case, it could be a case wherein for the intervening year, all those who were the advocates of a view that check transactions were not taxable, then perhaps would now be strengthened. Their case would be strengthened. Now, this is a very beautiful amendment which is sought to be brought out. It's what exactly had been the problem, one doesn't know. But what is in short is that anything which is considered as, ordinarily I would have taken, because it's very interesting, I would have taken you through so many things, but broadly appreciate that a market-linked debenture, which is considered as an MLD by SEBI, which is allowed to be traded in the market, is an MLD for the purposes of our discussion. Similarly, a specified mutual fund in respect of which the investment by the mutual fund in other investments is less than 35% of the total investments in domestic equities, then in such case it would be a case of SMF. These are the two cases which we are concerned with. Both these units as also the MLDs, especially MLDs, were considered to be long term because they were allowed to be traded on the stock exchange. They were securities. And therefore, in such cases, as and when they were transferred, before redemption or maturity, then in such case, they were considered to be long-term capital gains and they were eligible for a concessional rate, highly concessional rate of taxation. So since this is on since last couple of years, I would believe 4 years. So when these schemes, these are actually schemes for saving on taxes for high net worth individuals. This is what is. When these things were introduced, the questions were being asked, and certainly by me, that I was believing that that whatever is assured, because this comes with some kind of an assured return. This comes with some kind of an assured return. So therefore, the initial response was that why should it not be considered as a case of an interest, and it would be taxed on accrual basis year after year and not at the concessional rate of taxes. But it so happened that lot of bigger firms started giving opinions in writing, and the government also started accepting the taxation of MLD as the long-term capital gain and conferring the concessional rate of tax. Now, this is something somebody in the tax department or in the Ministry of Finance does not like this. So the amendment is now simply so, which is more or less on the lines of section 50. What does it say? Without amending to subsection 42A, without amending section 54 EC or any such thing, it simply says that any capital gains arising on transfer, redemption or maturity of these MLDs or SMFs would be considered as short-term capital gain. The related amendment is that in computing capital gains, what will be allowed as a deduction would be cost of acquisition, the expenditure. These are the two things would be allowed. No STT would be allowed. I would also believe that indexation also would not be allowed. Cost of improvement, if any, would also not be allowed. This is the sum and substance of the amendment. Now, what are the issues? Just let's understand. First, we would understand that the character of income now is frozen. Unless it is business income, it would always be capital gains. We had, as I discussed with you, that we had initial doubt whether it was income from other sources, interest, or it was capital gain. Now government has accepted that this is a case of a capital gain. It has also accepted the year of taxation would be only on redemption, maturity, or transfer, and not at any point of time before, because interest accrues from day to day or at least from year to year. So that taxation would now not be there. It would be taxed at the regular rates as in STCG. Now, benefit of reinvestment oriented tax exemptions, would that be possible or not? In the context of section 50 assets, when they are transferred, these are depreciated assets. The Supreme Court has confirmed the position in law that if the capital gain is reinvested in bonds or any such other asset which is otherwise eligible for claim of reinvestment related benefit, then in such a case, benefit would be conferred. Because 2 subsection 42A is not amended, none of the battery of section 54 provisions have been amended, it would be appropriate to take a view that when these MLDs are transferred and if they are otherwise long term, the period of holding otherwise is long term, and only under a deeming fiction the gains are considered to be what? Short-term capital gains. Then in such a case, there would be a possibility to claim exemption. I believe this position in law is reasonably clear unless one wants to turn around and say that there is a difference between 50 and 50 AA. And because of that, this benefit would not be possible. The other thing which also one may try is that as regards rate of taxation is concerned, one did consider in the context of section 50 or in the context of certain trust taxation that what should be the rate of taxation, whether should it be taxed under section 112 or should it be taxed at ordinary rates. There is a divergence of view between two tribunal decisions. One is taking a view that the concessional rate of tax is possible once an asset is otherwise a long-term capital asset. As against that, the other view holds something else. So therefore, one will have to take his own view before we take a final call. This MLD amendment has a retroactive application. I have already purchased MLDs before 31st March. And now if I transfer it, grandfathering is not permitted, and therefore I will face the music which will arise out of 50 AA. But fortunately, in respect of specified mutual funds, retrospective amendment, there is no retroactive application of this in respect of all those units which have been purchased up to 31st March. Grandfathering is permitted and the period of holding would be determined qua the period on which you had actually purchased those units. This acceptance of head of taxation is also accepted. Capital gains is accepted. The case of a dealer would not be hit by the provisions of section 50 AA. Now, this is another thing is important is that there could be cases wherein a transfer is taking place in the course of a demerger or amalgamation or corporatization and several other things which are listed by section 47. There are about 30 cases which are not considered as the case of transfer. Similarly, a liquidation is governed by section 46. So in all such cases, provisions of section 50 AA, I would believe, at least in 47 governed cases, would not be considered as a case of transfer, and 50 AA should not apply to such cases. But they may still apply to cases of 45.2 to 45.6 whenever they are applicable. They are deeming fictions. Determination of fair market value, unlike 50CA, which provides that in certain cases, how fair market value is to be determined, this particular 50AA does not throw any light. So one will have to determine the fair market value independent of the artificial aids. Benefit of indexation, exchange fluctuation, cost of improvement is not provided for, and therefore one would believe that it would be denied. Then in cases governed by 45.4, in some of the cases 48.3 applies in a subsequent year in respect of the assets which are continued to be held by the partnership. This benefit also of 48.3 would not be possible in cases governed by 45.4. Then a very important amendment, the talk of town and debate, which otherwise does not throw much of litigation. There are two provisions in Income Tax Act which permits you to make investments in purchasing or acquiring the residential premises. And when you do so, and if you do so out of the capital gains, which is long-term capital gains in respect of residential premises or non-residential, any asset other than residential premises, in both cases, you are entitled to claim exemption. And if you satisfy all other conditions, then you perhaps may not be required to pay any taxes. This is the sum and substance of it. The government this year is of a view that that these provisions, which are highly beneficial provisions, are being misused or abused by persons who have tons of money in their coffers, and therefore they are making investments in properties which are high value properties. This year the theme is high value, high premium and such other things. So therefore that what has been now provided is that there is an attempt, a constructive attempt is being made to prove that, that we are otherwise by nature socialist, if not communist, and surely not capitalist. So therefore now it has been provided that if your investment in a house property which you have purchased or acquired is 10 more than 10 crores of rupees, then the excess over 10 crores would be ignored. That would not be considered as an investment. Similarly, it is also so provided that if you have a capital gains which is more than 10 crores, the excess of capital gains over 10 crores of rupees would be ignored. So it's a two-way crunching, that they try to press you from both the sides. So that, and what is the, so therefore to give you an example is that you have sold a property for 15 crores of rupees. Your capital gain is 12 crores of rupees. You are reinvesting in purchasing another property whose value is 16 crores of rupees. Then you are covered from all corners and you are a fit case for application of amendments in 54 and 54F, right? So what are the issues that would arise out of it which have been left uncovered? This amendment is here to stay. Lots of representations were made, they have been to the deaf ears, and therefore they have not been responded. Even some very valid, suggestions, which we will see, have been ignored. So the sum and substance of this is that if you have a capital gain which is in excess of 10 crores, जो ऊपर का है वो उस पे exemption नहीं मिलेगा. If you have purchased a property worth more than 10 crores, that excess would be, for your computation of capital gains, would be ignored. This is what it is. So you should be prepared to pay the taxes for this. This is in short. And there is a consequential amendment which is made in the amount which is required to be deposited in a capital gain scheme account. So udhar bhi you should be careful, don't deposit more money because it will be waste of money. That's what it is. So now what are these? What are the issues? In some are interesting issues that would arise. Is this limit of 10 crores of capital gains and reinvestment, both these limits, don't ignore one for the another. So whether it is qua the owner of the property or qua each of the owner of the property. There could be properties which are held by more than one person. So it's a case of a co-ownership. Now you know that there could be different kinds of co-ownership, tenants in common, joint tenancy and other things. We are not here to discuss that. Take a simple case of joint ownership, which is a case of tenancy in common, which is known as co-ownership. There are two persons who are co-owners. The property is sold for 18 crores of rupees. A new property is acquired for 19 crores of rupees. And the capital gains together is 13 crores of rupees. In such case, the issue for consideration is that whether the limit of 10 crore would apply qua each owner or not. On a first blush, the reading of the provisions, one felt, especially the other part relating to the amount to be reinvested in property. Amount to be reinvested in property, one felt that it is, the ceiling is qua the property and not qua the co-owner. But on a second blush and a deeper consideration, I am of a considered view that the limit of capital gain as also the purchase consideration should apply qua each of the co-owner. We have lots of stories in the context of chapter 20A, 20C, in the context of section 27, and also within, in the context of 194I, and also 194IA, IB, and such other provisions. So therefore, one would believe, and there are some circulars also, which say that, the limits are to be applied qua each of the co-owner. Right. So therefore, even if there is a doubt, it's too early to concede. It's too early to concede that it is not possible. So I would take a view that is that in case of the co-owners, the limits should apply qua each of the co-owner of 10. Because as far as the co-owner is concerned, it is his property. It is his property. It's not a share in a property, it's his property. And we have several decisions of the tribunals and the courts which hold that even when you acquire a share of co-ownership, you are eligible for 54 and 54F. Am I not right? Yes. So there is no reason to not apply these decisions to this case. Then consequences on this is a worst case within 3 years. Assuming that you had claimed a benefit of section 54, which stipulates that you cannot transfer that asset within a period of 3 years. And if you do so, then the cost of acquisition in such case would be considered to be nil. I'm taking a complete exemption case, so let's not bother about partial exemption cases. So it will be nil. Now here is a case, because I have purchased a property of 15 crores. You have given me the exemption qua 10 crores only. And when I sell this property within 3 years, my cost would not be 5 crores also. It would be zero, because the entire cost has to be ignored. That's the way the law operates. This was very clearly explained. It was told to you by Pinakin Bhai also on the date of explaining the budget provisions also. BCS also had made representations on this, and I am told that it was not heard. And obviously it is not heard because there is no amendment to take care of this. Then there would always, this is believed that 54 and 54F are mutually exclusive. But there could be some strange cases wherein 54 may apply to part of the gains. 54F may also apply to part of the. So therefore, to provide ceilings, which are believed to be on the assumption that provisions are mutually exclusive also, is to my mind is erroneous. Then the next is that, so when I wish to claim 54F, 54F amendment provides that I can claim a maximum of 10 crores. Now I am happy with that. But in order for me to claim the maximum benefit of 10 crores, I have to invest more than 10 crores. So therefore, then the other condition is defeated. So there is an inherent defect, which is an anomaly in the provision itself, which one will have to take off. Then case of sale of more than one house. Case of sale of more than one house, there should not be, according to me, any difficulty. 54 would apply to both houses independently. Same way, when I am purchasing two different houses, the limit of 10 crores should apply qua each of these. Qua each of these, only difficulty could be that when there is a capital gain which is of 10 crores on sale of one house, and I am seeking to reinvest it in two houses, then while I can satisfy one condition of 10 crores per house, new house, but the capital gain, a limit of 10 crores would be something which would come in the way. And therefore, in such a case, this may not be possible. But if I have sold two houses and capital gains for each of them is less than 10 crores, and I have reinvested in taking two houses and not one, then in that case, there should not be a difficulty. Because these conditions, as I said repetitively, there are two conditions, not one conditions, and both will have to be cumulatively satisfied. Then transfer on or before 31st March 2023. I have no doubt that any transfers up to 31st March 2023 is not hit by the amendments. But because of the spurt of purchases which happened in the month of March, running into hundreds and crores, at times thousands of crores, that one was tempted to understand that whether it was so that even purchases, even capital gains of an earlier year or capital gains of subsequent year wherein the purchases are made before, yes, then in that case whether they would be covered by the amendment or not. As far as capital gains up to 31st March 2023, I believe that I should not have any difficulty, even when my purchases are post 31st March 2023 of 20 crores of house. But in cases where my purchases prior to 31st March 2023 and my sale is after 31st March 2023, Capital gain has arisen in a later period to which the amendment applies. So these are the cases which could perhaps will have to be examined with a microscope. 45(2) cases are always a problem. Please keep that in mind. Then intangible asset, the sum and substance of this is very interesting. And like perquisite and benefit, in respect of which we did spend a lot of time, this is one also would require giving attention for a considerable period. But now that we are moving ahead with the time, we will surely address the heart of it, the sum and substance of it. Section 55 is a provision which provides that in the aftermath of this famous case of BC Srinivasa Sethi, which said that when cost of acquisition cannot be determined, then in such case, it would be the entire consideration which you receive, full value of consideration, is not taxable if it is in the capital field. This is the sum answer. Post this decision of Supreme Court in BC Srinivasa Sethi, several amendments were made, starting with goodwill, followed by tenancy rights, then brand, then various production rights, manufacturing rights, and many other things. So in all such cases, it has now been provided that in such cases, the cost of acquisition will be assumed to be nil. And whatever therefore you would receive would be considered as capital gains. It could be long-term, short-term is a different thing, but it would be capital gains. So post these amendments, it was believed that, there would not be any such thing which would be left, which would not be covered by the amendments in section 55. But like government, taxpayers are also persistent. And therefore, many cases were devised, to prove that, the cost of acquisition was nil. And therefore, in such cases, there should not be any taxation. To plug these things, now government has come out with a major amendment to provide in 2 words that the cost of acquisition in case of any intangible asset would be nil, would be nil. And therefore, whenever you transfer any intangible asset, which is other than goodwill and other assets, even in such cases, now nothing is to be described. Now, any consideration which you would receive would be taxable in your hands as capital gains, obviously. Similarly, other amendment is made back to back in the same sentences. Any other right. Also, the cost of acquisition of any other right would be nil. And the explanatory memorandum, while explaining this also, had said that any intangible asset would be any intangible asset, and any other right could be any sort of rights. So therefore, any hope of understanding intangible asset and any other right with reference to the company which it is keeping, adduced in generous principle if it was applicable, then it was something like brand. So trademark perhaps is covered, or something similar to that is an intangible asset, because it will keep the company with that. So you would go to section 32, which defines intangible asset. You'll go to section 211, which talks of block of asset and intangible assets, which are the intangible assets. So all these issues were there. So in fact, the government was before the courts to prove that goodwill is not an intangible asset. Now the government would be of a view that anything and everything would be an intangible asset if it is otherwise qualifying to be treated as an intangible asset. Similarly, any other right would also be considered as too vast. And ordinarily, first time, one would feel that it is relating to business rights, and not beyond that, right? Manufacturing rights, selling rights, marketing rights. And when such rights are transferred for a consideration, then that would be so. But that is what may not be so. So we will understand this amendment with some examples. So first example which one has taken, it is at the bottom of the slide, is that right of first refusal. When we get into equity investments or any other investments, see that there is, or joint ownership cases, there is a right which is vested by the other person, vested into other person, which can be exercised. And this right at times is considered to be a valuable right, is at times considered to be a valuable right. In such cases, when you transfer this right, now whether that would be covered by any other right or not. So far there was no cost payable for this right. And therefore, there was a possibility, there are good number of decisions to support that it has no cost of acquisition. So now this will have a cost of acquisition. The other one which is affecting the investors in real estate is the case of TDR or the FSI. That is, when you're transferring transferable development right or the floor space index or the floor area restrictions. In all such cases, there is a consistency, including the decision of a Bombay High Court, which has taken a stand that when TDR is transferred by an owner of a land for which there was no cost of acquisition, then that would not be liable to be taxed. So therefore, whether this amendment would cover such a right or not, apparently, why not? Because this also is a right. And if you consider that the amendment is wide enough to cover any sort of rights, then this right also should be covered. So unless a very strong view is emerging out of the amendment saying that any other right is limited to certain rights and not these rights, then this would be taxable. Then a personal right also, because a personal right also, unless it is considered to be in the nature of a personal receipt, whatever you have transferred a personal right, if you receive something, that also could be considered if that personal right is otherwise considered to be a capital asset and not something which is outside the scope of 2 subsection 14. But a right to receive compensation under an accident insurance policy is a case, right, would not be considered as a case governed by the amendment. Then capital asset, any right which is capital asset related should be covered according to me. What should also be covered is a case of an actionable claims, which is transferable under the Transfer of Property Act also should be covered. Any compensation received for any violation of a right, when you receive it, that could also be covered. So would be allowances which are given to you, whose cost would be considered as nil. Importantly, even when you receive a mean profit, Supreme Court has held that mean profit is not taxable. But after amendment, it surely is a right to receive a compensation for deprivation of a property, and therefore in such cases also could be covered by this. Similarly, license, when it is license is a right, a easement right. So that also when it is transferred, assigned, there could be a this thing. We have a clarity in law that when a right to sue is compromised on receipt of a compensation, it is not a transferable right and therefore capital gains cannot arise. But because of this now, because of this, there could be a possibility that because of amendment that this right to sue also could be taxed unless it is demonstrated that it is not a capital asset and it could not have been transferred. Because importantly, even after amendment, 2 conditions will have to be satisfied. One is that there must be a capital asset. Make no mistake on this. There must be a capital asset and there must be a transfer. Simply because there is a right, it's not necessary that it will by itself. If it was not transferable, what I have received, not necessarily may be taxable. This is what is about the case of a slum sale when it is transferred. In such cases, I believe that there could be a difficulty of treating this as separately for the purposes of computing capital gains. It would be included, but then in that case, the slum consideration would also include the consideration for transfer of right, which could be a major issue. Business transactions are out. Yeah. Then we move to the next one. Yes. Can we discuss this later on? But this is not issue arising out of amendment. Goodwill is also covered. But after this is over, we will surely discuss, because I believe few minutes are left. And I wish to take up, at least finish the capital gains part of it. Thereafter, not much would be left, but let me complete this. This is interest as a cost of acquisition. There has always been a debate that whether interest which you pay over a period of years in respect of a loan which you are borrowed for acquiring a capital asset, mainly a house, whether that interest which you had paid could be capitalized and could be claimed as a deduction while you transfer the property. Okay. Normally, this interest is claimed as a deduction under section 24B, and in some cases under chapter 6A, wherever it was permissible. So Chennai Tribunal somewhere back said that even when you had claimed a deduction under 24B, you could capitalize this interest and claim it as a deduction in computing the capital gains. You had earlier decision of Mithilesh Kumari, wherein the court had cautioned that you better not claim double deduction. If you have not claimed 24 deduction, I will give you 48 deduction. This is what one, that was a high court deduction. But in spite of that decision, Chennai Tribunal took such a view. And that is what has made this government to come out with an amendment. So therefore, now what is interesting to me is that the position in law is settled that an interest can be capitalized. And interest can be capitalized and added to cost of acquisition, because there was a big debate over this, whether that could ever be capitalized, because interest for the post-acquisition period, could it ever be capitalized or not? But then we had decision supporting that. So now it is confirmed by the law that it can be capitalized, provided I have not claimed a deduction under chapter 6A or under section 24. This is, in short, is the sum and substance of the amendment. Okay, can I have 5.56 minutes? There are 2 or 3 important amendments in IFOS. One is, Anil, it's all right, no? Yeah, you are welcome to tell me to sit down. Yes, right, yeah. Okay, so here is the amendment which said that which is following an amendment which was earlier made somewhere in 2019 in respect of a non-resident. So if a resident of India were to give a gift of any sum of money to a non-resident outside the country, if that gift was taxable in India under section 918. So this provision was introduced in 2019, midway. But then there was also a view that if a resident of India had given a gift of any sum of money outside India to a person who was not ordinarily resident, then in such case, the earlier amendment could not have taxed the resident, not ordinarily resident. Now, this was something not believable to me, but the government took a bait, and therefore now has made an amendment to amply clarify. Again, not retrospectively. This time they have said that I will apply only prospectively. So there are now, the amendment of 2019 is reworded in 2 limbs. One is retaining the original one, and the later one is now providing that if any sum of money has been given to a resident but not ordinarily resident person outside India by a resident, then in that case it would be liable to tax under, it would be a case of a deemed income. It would be a case of a deemed income. If the gift was given in India, if the gift was received in India, I have no doubts about it, that it could never have covered it. I would have otherwise understood that if the case of resident was covered, a gift by a resident to a not ordinary resident would otherwise, if the gift was completed in India, in any case it was covered, right? So to put the issue beyond doubt, now it has been provided that this is what is the liability to tax in the hands of the not ordinarily resident person who is an NOR under 6 subsection 6. This is the story. So what we need to appreciate is that this is a case which is governed by, which would otherwise be governed by 56(2)(10 also, should be governed by 56(2)(10. So if the receipt is from a relative, then in that case, even if 9(1) applies, there should not be a tax. If the receipt is in the cases which are, there are 10 instances which are listed in 56(2)(10. I would therefore believe even those would apply to even 9(1) cases. And therefore, in such view of the matter, there would not be difficulty. It's only when none of these hits you, then there is a problem. There is one more thing also, is that limit of 50,000 would also apply. And importantly, it is restricted only to any sum of money. If shares were gifted to a not ordinarily resident outside India by resident, and if the locus, that is the situs of the company, happens to be a foreign country, then in such a case, in spite of this amendment, if it is true, then it would not be applicable. Am I clear in my this thing, right? So this is one amendment I thought we would cover. The other important amendment which is now carried out is that 56(2)(7)(b) is a case where a closely held company issues shares at a value which is higher than the face value of the shares, and that difference is higher than the Rule 11 UA value, or is a value which cannot be substantiated by the company. Then that difference was taxable when the shares were subscribed to by a resident. Now this restriction or limitation of being resident, receipt from a resident, is removed. So even when you receive from a non-resident, even when you receive share subscription from a non-resident, it would be governed by 56(2)(7)(b). This is one of the major amendments which have been, both of them are major amendments. That is 9(1) and 56(2)(7)(b) also, and 56(2)(10) also. So this 7B is subject to some of the exemptions, like in case of venture capital funds and such other things, startups and other things, they will not be hit by them. But other than that, 56(2)(7)(b) would apply to such cases, even where the pricing is approved under FEMA. Even where the pricing is approved under FEMA, RBI will take a different call, income tax authorities will take a very different call. So this is something we would keep in mind. But before you are in a hurry to apply this amendment, please look into the law which has been developed on 56(2)(7)(b), wherein it is considered that, where the transaction is between the relatives, or it is between holding and subsidiary companies, 56(2)(7)(b) cannot apply. There are decisions which also say where there is no abuse of provisions, when there is no underhand passing of the values, then in such cases the provisions cannot apply. But we do not have the time to discuss this, but please look into these facts which will have major impact. The last thing which we will deal on is the life insurance policy. This is also one of the major amendment which in an innocuous manner many of us have not noticed. What in short it is providing is that presently you have 10 subsection 10 capital D, which says that whatever you receive on maturity of life insurance policy is not taxable, is exempt, including what you receive by way of bonus. What you receive by way of a bonus. 2 years back an amendment came in respect of ULIP, and there उसमें आपको बताया गया कि 2.5 लाख से ज्यादा इन्वेस्टमेंट ईयरली होगा तो on maturity that would be considered as taxable. And, but they did not tell us that it will be considered as taxable under that income from other sources or as capital gains. And a circular was issued explaining that in case where there are multiple ULIP contributions, how it would go. So taking a leaf that, the amendment which was made 2 years back did not receive too much protest. Now the government is encouraged this time to make major amendments. And now what it is doing is that a policy which is approved by IRDA, right? Insurance regulator has approved the policy. It has approved the premium also. If you take such policy and the premium happens to be more than 5 lakhs of rupees, annual premium, then in that case, whatever you would receive on maturity, after deducting the amount paid as premium, would be taxable in your hands under the head income from other sources. So 2 amendments, exemption denied and income taxed as income from other sources. The third amendment is when you subscribe to multiple policies, all this applies to policies issued on or after 1/4/2023. It's not retroactive, so don't worry about it. So here, if you subscribe to multiple policies and the aggregate premium of these policies happen to be more than 5 lakhs of rupees, then in that case, the policies, the last of the policies, which is over and above 5 lakhs of rupees premium, those policies would be denied the exemption, right? And there will be a circuitous, convoluted way of calculation which the government has reserved the right to prescribe that how premiums will be calculated and which policies will be excluded, which has all happened in the circular number 2 of 2021 in ULIP's case also. But without bothering you with that, the sum and substance of it is this. So 1 or 2 questions which we need to consider is that what happens to the case of a single premium policy? What happens to the case of a single premium policy? And what happens to the case in contrast to that, to a case of a person who had not paid premium for many years and therefore was in arrears and has now paid a premium which is about 30 lakhs of rupees. So contrasting these 2 cases as an example, in case of a single premium policy, the amendment would hit you. But in case of the payment of arrears, the amendment would not hit you. If you appreciate these analogies, some of the other points which have been placed before you would be understood in the proper context. Please read this, it is interesting. Last amendment which I would consider is the case of a business trust. This is also a fantastic provision and therefore we need to consider. This is not a provision which is affecting business trust. It's a provision which is affecting ordinary investors like us, that is unit holders. So there are two people involved in this game. One is a business trust, which could be InvIT or which could be a REIT also, right? Which issues units. And when units are given to you, what does it do? It gives you, 4 things. It gives you interest in some cases. It gives you dividend in some cases. It gives you rent also in REITs cases. And it gives you something else also. And then some of the REITs like Embassy and all gives you something more also. So there are 5 kinds of distribution. So the first 3 kinds of distribution, that is rent, dividend and interest, are enjoying the pass-through status. They are not taxed in the hands of the business trust. But where are they taxed? They are taxed in the hands of the unit holders, right? And the income would retain the same character in the hands of the unit. So rent rahega, dividend rahega, interest rahega. The other income which the business trust used to earn was taxed in the hands of the business trust. So there was no pass-through for that. But that was then not taxable in the hands of the unit holder. So it was no dual taxation and it was comfortable. But in the last couple of years, there came out a new strategy. Whereunder what used to happen is that they started distributing, something which was not in the nature of the first four. They started distributing which could either be considered, which was labeled as return of debt. Return of debt. As a unit holder, I have not given any debt to my business trust, but return of debt. Some would say return of capital, and some would say mix of return of debt and capital. So in the story which we have so far understood is, the last thing which we were to understand was that when these units were redeemed or sold, what would happen would be capital gains in your hands. And the cost of acquisition of units would be deductible. Simple, no? This is something simpletons like me understand. So this was good. But after this variation started happening, a view was being taken that what was the return of capital should not be taxed. Maybe yes, maybe partly one would agree that मेरा पैसा मेरे को वापस देता है, तो how could there be a capital gain? Fair, right? But even debt was considered to be not taxable. Return of debt was considered to be not taxable. For this to explain to you that how a debt could be returned, I need to explain to you the entire strategy of running an InvIT or a REIT. So which is not something which is desirable also. And more importantly, I'm not an expert. To take care of this, see now Deepak has kept a lecture, of my very dear friend Gautam Nayak. So he is going to talk with you, on these aspects in this month only. So yeah, in that home series, I believe, right? Yes, yeah. So and he is a better person on this. So coming back to this is that this return of debt, see right now was a practice or which was an abuse of practice or a misuse of practice. And this was neither being taxed in the hands of the business trust or in the hands of the unit holders. The government, not liking this, now has provided and has come out very heavily now, has said that whatever you receive, that would be taxable as income from other sources in the hands of the unit holder, not in the case of business. So when this amendment was proposed, see, there was a lot of hue and cry, and obviously so, that how can a return of capital be taxed? So therefore now a proper formula is provided. This amount which you would receive, which will be other than interest, dividend and rent or other income, which has suffered tax elsewhere, will be reduced from the sum which you receive. That will be number one exercise. A minus B minus C is specified sum. So what remains after deducting the first four? What remains after deducting the first four would be considered as income from other sources. Simultaneously, an amendment is made in section 48(2) to provide that cost of acquisition will also be reduced if what you have received is not 1, 2, 3, 4, 5. So if there is a return of capital which is over and above this, that will stand reduced. And so that in the ultimate year, I presume this to be so, in the ultimate year of redemption, maturity or transfer, that remaining cost will be allowed as a deduction. But before that, a lot would be taxed, and mainly as income from other sources. So this is something which we need to keep in mind. With that, ladies and gentlemen, I'm extremely thankful to all of you for having given me a patient hearing. I will really welcome your views on this. You're welcome to write to me, because I do not think there would be much time left for interacting and responding to the questions. So whosoever writes to me, on email, we will surely respond to that. Thank you once again. Thank you very much.